Every generation believes its prosperity is permanent, its financial system unbreakable. But history offers a harsh, sobering counter-narrative, a chilling reminder that the greatest economic downturn in modern memory didn't arrive with a bang, but a slow, agonizing collapse that reshaped the world. We're talking, of course, about the Great Depression. But this isn't just a story from the past. It's a blueprint for understanding economic cycles. It's a stark warning about market history and an essential finance lesson for today. We must learn from the past to navigate the complexities of our present. To understand the Great Depression, we must first rewind to the Roaring Twenties. Post-World War I, America was booming, a nation intoxicated with victory and innovation. Factories churned out goods on an unprecedented scale. The automobile, once a luxury, became a symbol of freedom for the burgeoning middle class. Radios crackled in living rooms, connecting the nation. Credit was cheap and plentiful, and a new era of consumerism took hold. Buy now, pay later. The stock market, once the exclusive domain of Wall Street titans, became a national obsession. It was the playground of everyone, from bankers to barbers. Investment history shows an unprecedented surge in optimism. Everybody ought to be rich, one popular magazine declared, and for a time it seemed true. People bought stocks on margin, a dangerously seductive form of leverage. They put down as little as 10% of the price, borrowing the rest. As long as the stock price went up, the profits were immense. But if it fell, the losses could be catastrophic. This was a classic financial bubble in the making, fueled by easy credit and an almost religious belief in a new era of perpetual growth. Even before Wall Street, warning signs flashed. A massive real estate bubble in Florida burst in 1926, wiping out fortunes, but the nation ignored it. Banks were lending recklessly, not just to businesses, but to investment trusts and individuals buying stocks. Their foundations were intertwined with the market's fortunes. And internationally, a precarious global debt structure was forming, a tangled web of war reparations from Germany and loans from the United States. The economic theory of the time, often dubbed laissez-faire, advocated for minimal government intervention, believing the market would always self-correct. This period of unchecked capitalism history set the stage for a spectacular fall. The very foundations of wealth history were being built on increasingly shaky ground. The end began subtly. By the autumn of 1929, steel production was down, construction was slowing, and consumer debt was at an all-time high. The party was quietly ending. Then came October 24, 1929, Black Thursday. The market opened to a storm of selling. The ticker tape ran hours behind, creating an atmosphere of blind panic. Crowds gathered on Wall Street, staring in disbelief at the House of Morgan, hoping for a savior. A palpable tension hung in the air. A group of powerful bankers formed a bankers' pool, buying up huge blocks of stock to try and stabilize the market. It seemed to work. A temporary rally ensued, but the confidence was gone. Over the weekend, investors across the country absorbed the news and decided to get out. The fear was contagious, spreading like wildfire. Black Monday, October 28th, was a bloodbath. The market fell nearly 13%. The bankers' pool was overwhelmed. There was no one left to stop the fall. The next day, Black Tuesday, the dam truly broke. 16 million shares were traded. The market lost another 12%. The Roaring Twenties were officially dead. The stock market crash history of these days saw billions of dollars in wealth evaporate. Fortunes built over years were wiped out in hours.
Margin calls went out across the country, forcing investors to sell, which drove prices even lower in a terrifying feedback loop. Panic was total. But the crash was not the Great Depression itself. It was the trigger, the initial spark that ignited a much larger, more devastating fire. It exposed deep structural flaws in the global financial system. People's life savings tied up in stocks vanished overnight. Confidence, the invisible force behind any economy, shattered. Without it, the entire edifice began to crumble. Businesses, seeing demand disappear and credit freeze, began to cut production and lay off workers. This wasn't just a stock market correction, it was the start of an unprecedented financial crisis.
What followed was a complex, devastating chain reaction that turned a stock market crash into a full-blown Great Depression. Each event triggered the next. First, bank runs and failures. With confidence gone and investments lost, people rushed to withdraw their money from banks, desperate to save what they could. Imagine it. A rumor starts. The bank is in trouble, you hear. You run to get your savings. Your neighbor sees you, then the grocer. Soon, the entire town is there. But banks operate on a fractional reserve system, meaning they don't keep all deposits on hand. They lend most of it out, assuming not everyone will withdraw at once. When too many people demanded their money back, the banks simply ran out. The doors closed, and for millions, their life savings were gone forever. Between 1930 and 1933, over 9,000 banks collapsed in the U.S., nearly a third of the country's total. This meant billions more in lost savings and a complete paralysis of the credit system. The entire financial framework froze. The lack of central banking oversight and federal deposit insurance meant there was no safety net, nothing to catch the falling economy. Second, deflation. As demand plummeted and production ground to a halt, prices for goods and services fell dramatically, a phenomenon known as deflation. While lower prices might sound good, in a deflationary spiral, it's catastrophic. People postpone buying, expecting prices to fall even further. Businesses couldn't make a profit, so they cut wages and laid off more workers. This further reduced demand, creating a vicious cycle. Farmers, already struggling with debt and overproduction from the 20s, were devastated. Crop prices collapsed, leading to mass foreclosures. This created a phenomenon called debt deflation. As prices fell, the real value of debt went up. The money people owed became a heavier and heavier burden. Third, international trade collapse. The crisis wasn't confined to America. The global nature of finance meant that as one nation stumbled, others followed. In a disastrous move, the U.S. passed the Smoot-Hawley Tariff Act in 1930, raising taxes on over 20,000 imported goods to protect American jobs. It backfired spectacularly. Other countries like Canada, Britain, and France retaliated with their own tariffs. Global trade was choked off. Between 1929 and 1934, world trade fell by an astonishing 66%. This was a stark lesson in the interconnectedness of global finance history. Fourth, monetary policy failures. The Federal Reserve, the U.S. Central Banking Authority, made critical errors that deepened the crisis. Adhering to rigid economic theories like the real bills doctrine, they believed they should only lend to banks on short-term commercial loans, not to stop panics. Instead of injecting liquidity into the banking system to prevent collapses, they often tightened the money supply, raising interest rates in 1931 to protect the gold standard. This constricted credit further, starving the economy of the money it desperately needed. It was like taking water away from a man dying of thirst.
Many historians, including Milton Friedman, argue that these misguided monetary policy history decisions turned a severe recession into a cataclysmic depression. The human cost was staggering. Unemployment soared to nearly 25% in the U.S. at its peak, with millions more underemployed. Families lost their homes, their farms, their dignity. Hope was a scarce commodity. The Dust Bowl environmental disaster compounded the misery for farmers in the American heartland, forcing mass migrations. Soup kitchens and bread lines became common sights, a stark and public symbol of the nation's struggle. Initially, President Herbert Hoover advocated for rugged individualism, believing voluntary action and local government should handle relief. But the scale of the crisis overwhelmed these efforts. His administration's attempts were too little, too late, earning him widespread scorn. This period highlighted the inherent tension in capitalism history between market freedom and social responsibility during an extreme financial crisis.
The election of Franklin D. Roosevelt in 1932 ushered in a new era of government intervention, the New Deal. Key initiatives included the bank holiday and FDIC. Roosevelt immediately declared a bank holiday, closing all banks to prevent further runs, then reopened only those deemed solvent. The creation of the Federal Deposit Insurance Corporation, or FDIC, guaranteed deposits, restoring public trust. Public works programs like the Civilian Conservation Corps, or CCC, and the Public Works Administration, or PWA, put millions of unemployed Americans to work building infrastructure. The Social Security Act established a national system of old age insurance and unemployment compensation, creating a vital social safety net. The SEC was established to regulate the stock market and prevent the kind of speculative excesses that led to the 1929 crash. While the New Deal didn't end the Great Depression overnight, full recovery didn't come until World War II. It provided crucial relief, restored confidence, and fundamentally reshaped the relationship between the government and its citizens. It demonstrated that government action could mitigate the worst effects of economic cycles, a profound lesson for the future. So why does the Great Depression still matter today? Because its economic history offers invaluable finance lessons that echo in modern challenges. First, the fragility of financial systems. It taught us that even seemingly robust systems can collapse. This lesson was painfully relearned during the 2008 financial crisis. Second, the role of government and monetary policy. The Depression highlighted the crucial role of central banking and government in stabilizing economies, preventing bank runs, and providing a social safety net. Third, the danger of speculation and bubbles. The Roaring Twenties speculative boom and subsequent bust serve as a perpetual warning against irrational exuberance and unchecked risk in market history. Fourth, deflationary spirals. And fifth, the interconnectedness of the global economy. The Depression showed the devastating power of these forces to drag the entire world down. The Great Depression was more than an economic event. It was a profound societal shock that forced a reevaluation of capitalism history and the role of the state. It taught us that while market trends history doesn't repeat exactly, the patterns of human behavior, greed, fear, and the search for stability endure. History doesn't repeat, but if you ignore it, it will crush you all the same. The lessons of the Great Depression are still whispering in our markets. Are we listening?